Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe and click the bell so you get a notification of when we're releasing a new video. I'm sitting today with Michael Porter. Hello, Michael.
Yeah, morning, Robin.
Nice to see you. Yes, nice to see you out of the sling. And as you say, the mountains are white. So we've had a very cold week here.
Sure.
Michael, talking about cold weeks and mountains, mountains tend to be a little bit jagged. And it appears we've seen just over the last little while some outsized moves based on even some good results in shares. I mean, not a terrifying result, but the share price gets hammered and goes down 8-10%.
Yeah.
I think you need to help all of us, please.
Yeah, I think one of the things that's happened over the last 5 years, Robin, it's probably been evolving for quite a long time, but obviously algorithmic trading has become more and more popular where, trading is more done by machines than by humans, and I think AI is just accentuating this process and accelerating it. And so you have a result that comes out. If there's one or two slight disappointments relative to expectations, the share price just gets hammered. And from what I can see and from what I can read and just the reaction generally, it's not humans that are forcing these share prices all over the place. It's computers and algo trading that is forcing share prices to do what they do. So I mean, this week we had Nice Person Process didn't come out with results, but Tencent came out with results. Very solid results. Revenues and profits were up, but the one thing that they I suppose the one aspect of the results was that their cash flow is slightly weaker because they're investing a lot in AI and things like that. Now, the market is completely schizophrenic on something like that. Some companies come out and say they're investing behind AI and the share price does 20% on the upside. And some companies come out and say we're investing in AI and it does 20% on the downside, know. And so, we still firmly believe that Tencent is ideally positioned. They're investing quite a lot behind their agentic agents, and they've obviously got this massive ecosystem that obviously they can monetize. And so the market's just taken complete fright, but it's not I say complete fright. Nice Person Process were down 8% or so on Wednesday, and that's just computer trading and all these algos coming in and hitting the share price like that. Because actually, fundamentally, there was nothing weak in the results. Tencent's not loss-making. It's not unprofitable. It's making good money. The valuation's the cheapest that it's ever been. And they're obviously laying the foundation for the next sort of wave of growth. So I think maybe the message for me if investors see that kind of volatility, there's quite a few examples I could go through, but we're not going to go through each one, but is actually not to panic because sometimes, yes, a company might really have a disappointing result and come up with something that is out of left field, and the share price, is deserved, or the reaction is deserved on both sides. But I would say 90% of the time, it's not that case. And actually, just be a little bit more circumspect and don't panic when you see those kind of share prices, because I think unfortunately, markets have become with computer trading, they're much more speculative than they used to be. Unfortunately.
Yeah. So, Michael, if we're talking computer trading, maybe one of the things that we can highlight is, in this space, is the entire passive investing spot. So, passive is enormous. I think it's almost 50% of global markets now is passive, and the thing that everyone looks at as a passive fund is how accurately does it follow the index that it's supposedly replicating. The only way you can do that is with computer trading. And if something starts to move, if you've got that much money behind, say, one particular share, and it's now being sold down by an algorithm somewhere else, the passives all have to follow it. and there's a lot of money following it, and markets are a zero-sum game, so someone has to be buying on the other side, don't they? I mean, it's
Well, exactly.
You can see where it comes from, doesn't
yes.
it? Yeah.
But passive is almost a self-fulfilling strategy, almost, because essentially it's a momentum trade. I mean, if things are going up and you're getting inflows, you basically have to keep on buying it. It's completely valuation agnostic. It's not worried, okay, well, actually, I think this is looking a bit expensive now, or this is looking quite cheap. It doesn't care. You're just buying exactly whatever you're following,
Yes.
and yes, so by the same token, that works on the upside and you get this massive momentum, but on the downside it also works, and then the passive just comes in and they're forced to sell. So yes, I think passive has changed the nature of markets, but in there's an opportunity for, I think the opportunity for active managers is to find, I mean, certainly you can find things that are ridiculously overvalued that you no longer want to hold, and also opportunities that are almost being overlooked, because if your share is not being tracked by some sort of passive index, you can be completely ignored almost, So actually, the more it goes passive, the more opportunity there is for people to go and sift through opportunities in a way. Yeah.
So Michael, one of the things we talk to clients about is the difference between speculation and investing. And speculating is a very short-term game. You can speculate for a minute, you can speculate for an hour a day, but investing is taking a view and watching it play out over a long period of time. And I think we've got a really, really good example in our local market, which is Standard Bank, which I think released interims, was it? Yesterday, yeah. And I mean, there's a good example of a share that didn't do much from a share price for a long period of time, produced the income, and the income increases, and now we've been rewarded for the long-term view on that.
Yeah, Robin, I mean, obviously COVID was, if people remember back to COVID, and it's actually hard to think that it was more than, well, I suppose 6 years ago now, but the banks weren't allowed to pay dividends for that year, if you remember back. But at the end of 2021, so that was a year after COVID, Standard Bank paid a dividend of about 890 cents or 800, somewhere around there. And this year they'll probably pay double that. So in 5 years, the dividend will have gone up 100%, But for 15 years, Robin, 20 years, Standard Bank has been building an African operation, They pulled back from some of their global operations, London and Argentina and other things, where they really they struggled a bit and they lost their shirt on one or two things, but they've been building this African franchise. They're active in sort of 20 African countries. They've got dominant market shares, but the whole portfolio effect just comes through. Standard Bank South Africa, obviously the South African operations are doing well. The rand was a bit stronger, so when you convert the African operations back into rands, it wasn't quite as strong growth as the underlying currency. But Standard Bank is just a very solid investment. Even last year, Robin, we were doing our year-end presentation. We used Standard Bank as an example quite often. I think the share price was 260 Rand. It's now 330 Rand. So it's done 25% in 8 or 9 months or whatever it is. And the dividend is up 10 or 12%. And it's just one of those shares. There's many examples in the market, but it just compounds away. It's a good business. It's got a good management team. It has periods where the share price does nothing for a year or 15 months. It'll just consolidate. It'll go nowhere.
Or longer.
Yeah. But the dividends come through. The profits keep on growing. As an investor, if you're getting 10% growth in your dividends, that inflation's 4.5%, you shouldn't be expecting anything more than that. Inflation plus 5 or 6% is absolutely bang on.
Yes.
And yes, and then at times the market then loves it and the share price sort of catches up. But it's just a great compounding story. And I agree. It's not always sexy, Robin, but it delivers the goods. And sometimes boring is much more preferable to being in the sexy thing,
100%, Michael. Speculators won't like that. Michael, thanks for coming in, giving us that insight. Thank you for tuning in. Don't forget to like and subscribe. We'll catch you next time. Bye-bye.